I started investing at 18 and therefore I made a lot of mistakes. However, I learned a lot of valuable lessons from these mistakes that I'm going to share with you guys in hopes that you can avoid them. My first mistake when I started investing was not dollar cost averaging. Dollar cost averaging is when you consistently buy a stock over time, and that way you get an averaged out overall buy-in price. For example, if you dollar cost average the S&P 500, that could look something like buying $100 of the S&P 500 per week and just buying that over a year's time. Just investing $100 every week, and that way your price is averaged out throughout the year. The benefit of getting an average buy-in price is that you don't have to try to time the market. You can buy in on those highs and you can also buy in on those lows. You'll buy in when the market crashes and you'll also buy in when the market is high. And so you don't even have to worry about timing the market. You don't have to worry about buying in right before a crash or right before like a giant uptrend. You just buy in. Timing the market is really risky because if you're wrong, the stock could shoot the other way and you'd lose money. So when you get an average, you completely take away that risk. DCAing is also a great strategy to employ when the market is crashing. For example, if you're investing in the 2020 market crash, that would have been a really scary time to start putting money into the market. I mean, stocks were falling 7 to 10% per day, which is ridiculous. Most people would be scared of catching that falling knife and buying in at the middle of the crash and then having their money drop an extra 25%. Nobody wants that. But if you dollar cost average throughout the dip, so it drops 10%, you buy some, drops more, buy some, drops more, buy some, then you'll get an average overall price for the dip, and when it goes back up, you will have made some really good profits. The second thing that I wish I knew about the stock market is that you don't have to look very far to find deals. I mean, a lot of people, when they first start investing, they think they need to like scour the stock market, find some like hidden small cap stock, and then get in before it 10x's, but you really don't need to look that far when looking for a deal. A lot of the big companies are great deals. I mean, obviously it depends on the market that we're in, but a lot of the time, like Disney, Apple, Amazon, they're one of like the people that have the highest potential for growth, even though they're already like a huge company. For example, let's take a look at Tesla about 1.5 years ago. That stock had been ignored by so many people and it was extremely undervalued and it was in plain sight. Literally on like most people's homepages, they could just see Tesla at $300 a share pre-split, which is ridiculous. And nobody bought in. I mean, until it started shooting up, nobody noticed it. So a lot of the times those deals can just be in plain sight and you just have to look for them. Just remember to invest in what you believe in and be extremely bullish when the market crashes, because that is the time that all these big companies are at an extreme discount. So get them while you can before they just take off to the moon. Even though companies are large, they can always get bigger. The third thing that I wish I knew about the stock market before I started investing is that market crashes are good. A lot of times a market crash can act as a breather and a great discount for stocks on the overall long run of the market. When a market gets overvalued or it's had a really long bull run, usually it's not that healthy for it to keep like inflating even more. It needs to die down a little bit before it starts going back up. So market crashes are the perfect way for the market to take a breather. When the market crashes and your portfolio loses like 10 to 20%, that is a very scary thing to have happen. That's like 10 to 20% of all the money you've saved just gone, which is terrifying. And a lot of people are tempted to just sell. But in fact, this is the time that you should hold or buy more. Whenever I see a red day or see a market crash, I always just load up on my favorite companies. And then as soon as the stock market goes back up, I will have made some really good profit. Just remember that market crashes are normal, and we have never seen a market crash last for more than 10, 20 years. So over the long run, you will get your money back. You just have to be patient and wait. Especially when you are older and closer to retirement, it can be extremely scary to see the market crash. That's because your overall portfolio, which is basically your retirement savings, goes down 10, 20%. That's like 10, 20% of your working years just lost in the span of a week or a month. But just remember, over time it will go up. And as you get older, you should start developing an emergency fund with 3 to 6 months of your expenses so you can ride out those market crashes and you're not forced to sell at the bottom. An emergency fund with 3 to 6 months of your expenses in cash is a must-have when you get older. The next lesson that I learned is that day trading kind of sucks. Day trading is hyped up by all the gurus on the internet trying to sell you courses and promising you insane returns, but in reality, the majority of people are better off just investing in like a long-term index fund or just very safe stocks. Day trading is extremely risky, and if you don't believe me, let me tell you my story. When I first started investing, I decided to try day trading. I started out with only $100 because that was my risk tolerance and I was in high school, so I didn't have that much money. After about a month, I had made a 30% return and gotten all the way up to $130. That's a crazy return. I mean, if I kept that up over the next 11 months, I would be making 360% per year, which is way more than like Warren Buffett. I mean, I was hyped. I was like, oh man, I'm amazing at investing. But in the span of one trade, I bought this one penny stock that was worth, well, I guess it wasn't a penny stock. It was worth $4. I bought that, and within the span of one trade, I lost all my 30% and I was back to $100. That taught me the true dangers of day trading, because all that month of work was just gone in one trade. All it takes is one trade to destroy your portfolio. And this is even amplified with options trading. Options day trading is even more risky, but I'm just talking about normal day trading. I will admit that day trading is not all horrible. If you're a really advanced stock trader and you've been investing for years and years, you understand like patterns, trends, then you can make money day trading. For beginners though, I would not recommend day trading unless you're willing to lose some money. Now, I know that sounds like it would suck and why would I even try it, but it can be a good lesson. I mean, I learned so much from using that $100 to day trade, and if I had lost that whole $100, the knowledge that I would have gained from doing those day trades and learning about the markets is worth way more than that $100 was. So if you have some money that you're okay with losing and want to try day trading, I say go for it. The next thing that I wish I knew when I first started investing is that you shouldn't look at the markets every day, especially if you're holding long term. Looking at the markets every day can really like get inside your head, and you can start paying attention to short-term news, and that could like get you to prematurely sell your stock, which is very bad. Especially if you're holding for the long run, any short-term news or any bad news about a company that you believe in usually does not affect you in the long term, and it just stresses you out and gets inside your head. There's no reason to look at it. You are much more likely to sell a stock that you believe in and think will do good over the long term if all you've been hearing about it is like, oh, their CFO has retired and the company is going to crumble, and then the stock price just keeps going down for a month or two. That can really like mess with your head. And so a lot of people sell in those situations, even if they do believe in the company long term. This definitely depends on the type of person you are. If you get easily stressed out or scared that you're going to lose money, then I would just not look at the market every day. Just check it like once a month, once a quarter. It doesn't really matter. I mean, your stocks are still going to go up or down, and there's nothing you can do about it. However, if you're like me and you're a stock market nerd, then looking at the markets can be pretty fun. I mean, I look at the markets probably almost every day, and I love watching my stocks go up or down. It doesn't really matter to me because I know over the long run, they're going to go up. Speaking of the long run, the next lesson that I learned is that the stock market is not a short-term game. When you trade in the short term, you are playing a risky game that is very comparable to gambling. When you trade over the long run, you are playing a very safe game called investing. Index funds, in my opinion, are the best long-term investment because they're extremely diversified and provide consistent growth. You can even look at their track record, and most of the time, that track record is what is going to continue forward. When you hold an investment for the long term, you are most likely going to get a better tax rate on it. For example, if you hold a stock for over a year, then you're going to get long-term capital gains tax instead of short-term capital gains tax, which you will get if it is under a year. Short-term capital gains tax is like double what long-term capital gains tax is, so make sure you're holding for a year, or else you're just giving 20% of your profits away to the government. Another benefit of holding for the long term is that you're taking advantage of compound interest. So your money is basically exponentially growing over the long run, because as you gain interest, your money will make you more money, and then the money that your money made you will make you even more money on top of that, and it looks like an exponential graph. This is how the average American becomes a millionaire. The next lesson that I learned about investing in the stock market is that your returns are relative to your principal. This one can seem kind of obvious, but you'd be surprised how many of people go into the stock market with like $1,000 thinking they're going to make 30 grand next year. It doesn't work like that. If you are starting to invest in the stock market with a relatively low amount, such as $1,000, then your returns will probably not change your life. I mean, the average return for the S&P 500 is around 10%. And so if you put that money, that $1,000 into the S&P 500, then the most you'll make is usually around $100, which is significant, but you will not be generating tens of thousands of dollars a year from your original $1,000 investment. However, if you made that same 10% return with $1 million instead of $1,000, then you'd have $100,000. So you'd be making around $100,000 a year. Now that is life-changing money. So like I said, your returns are relative to principal. If you're hearing this and thinking, dang, I really expected my money to go farther in the stock market, if you don't have much money, you'd probably be better off investing in a business or something that can generate you more money. However, if you don't have that much money, but you still want to invest in the stock market, do not be discouraged. The knowledge that you'll gain from trading that small amount of money can be worth millions once you start putting more and more money into the stock market. One mistake that I made when I first started investing into the stock market was investing in penny stocks. Remember that 30% loss in one trade that I talked about earlier? That was a penny stock. Penny stocks are very volatile, so they can go up and down very fast. This means that you can make good money off them, but you can also lose a lot of money off them. And these companies are priced low for a reason. They're not like, the Apples or Amazons who are priced very high because they're great companies. These companies are priced low because they're not very good companies. These companies have the opportunity to go bankrupt, and so I would only mess with them if you're a very experienced trader and understand patterns, trends, etc. If you're a beginner, treat penny stocks like a roulette wheel. Another mistake that I made was over-diversifying my portfolio. When you first start investing in the stock market, you can get really excited about going and buying all your favorite companies, but if you buy too many of those companies, you could actually be over-diversifying your portfolio. This means that you have too many stocks. If you have, let's say, 20 stocks and one goes up 10%, that's a massive increase, but because you have 19 stocks that stayed the same and only one stock that went up 10%, you're not going to get that 10% return. You're only going to get 0.5% return. However, if you have only 3 stocks in your portfolio and one goes up 10%, then you'll make around 3%. And if you want to be extremely diversified, that is completely okay, but I would just recommend going and buying an index fund. The smaller your portfolio is, the less amount of stocks that you should have, and the larger your portfolio is, the more amount of stocks you should have. This is because when you have more money, you are more focused on preserving your initial investment than trying to make insane gains. But while you have less money, you're trying to grow your portfolio and are okay with taking on a little bit more risk. That is it for my investing mistakes. I've certainly made a lot more than that, but those are the ones that I feel like will help you guys out the most. So those are the ones that I'm going to give you, or else this video would be like an hour long. I hope I bring you some value, and if you want to learn more about the stock market, then I recommend you follow along with the channel by subscribing. If you have any questions, make sure to comment them down below and I will get back to you. P.S. I'm sorry if my talking was a little rambly at times. I'm trying to do longer segments without cuts, so sometimes I'll kind of go off on a tangent and I will mess up, but I won't cut it out because I'm trying to learn how to talk on camera. So apologies if that bothered you at all, but it's a process, so we're going through it. Thank you all for watching.